period of time. This will throttle the amount of oil as well as gas that will come out of the region, tightening supply in the market to a degree and lead to higher prices. But clearly, I mean, you look at where we are right now, around high $70, $80 for Brent. That is not the worst we've seen since the war began, when it's at $120 levels. So while there is this fear and this risk that Hormuz traffic will be disrupted for longer, perhaps a short period, there isn't quite a fear in the market that we're spiraling to the worst that we saw in March, where you would see assets across the region being attacked, and there was a risk of a real, somewhat prolonged period where production could be disabled for months on end.
So, Stephen, you already mentioned that this might disrupt the shipping in the Strait of Hormuz going forward, but only a week ago or so, we were talking about all these big banks coming out with their prospects for an oversupply glut in the market by the end of this year. Where do the latest escalations leave things when it comes to that overabundance of energy supplies?
I think an interesting thing that has happened over the last 3 months is they've really tested how resilient the oil market is without oil and crude from the Strait of Hormuz. I mean, last year, the Strait made up about 20% of global seaborne supply would go through that waterway. But now there are a lot of alternatives that are being worked out. I mean, Saudi Arabia has really ramped up output from the East-West pipeline, able to get more of its oil out of the Persian Gulf into the Red Sea and through the Bab el-Mandeb Strait to customers in Asia. At the same time, ADNOC from the UAE has been able to create a shuttle service to get its oil out of the Persian Gulf to Fujairah and reload shipments and get that to its customers. And even now, Iranian shipments are able to continue to get out despite the strikes and the rising tension. So I think there is a view that the market is able to deal with a closure to an extent. You've seen an interesting rebalancing where Chinese imports dropped pretty significantly in the May-June period, which helped balance the market and allowed for the crude shipments to go to other customers. That has resulted clearly in this sort of glut or oversupply, at least in the near term. And that does provide some cushion, which takes away some of the risk of us rising to the $100 handle for Brent, at least.
All right, Stephen, thank you as always for your time. Stephen Stipczynski, who leads our Asia energy coverage. Now, still ahead, we'll continue the conversation on the energy impact from the latest strikes on Iran and oil flows through Hormuz with Karen Young from Columbia University's Center on Global Energy Policy. But up next, the outlook for the second half of 2026 with Max Kettner from HSBC. This is Bloomberg.
NFTs have not recovered in the same way that, say, Bitcoin has.
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
is gathering pace in Asia as traders hunt for cheaper ways to play the tech boom. This comes as markets appear largely unfazed by the latest escalations involving the United States and Iran. Joining us now to discuss the latest market moves is Max Kettner, Chief Multi-Asset Strategist at HSBC. Max, good to have you on this morning. You've remained overweight on equities through all these macro or persisting macro themes. Can you walk us through just why exactly that is?
Yeah, good morning, and thanks for having me, Abir. Look, I think one thing that is quite